Hello and welcome to San Diego Market Watch, where we bring you local, timely, accurate real estate information about what's happening in San Diego. So let's jump right into it. The number of homes for sale has been very steady for the past several weeks. In fact, our chart only goes back to June here, and a couple of weeks before this is where the inventory ran up from, just over 3,000 or just around 3,000 to well over 4,000, and then almost up to 5,000 toward the end of July, and it's been just sort of steadily falling off since then. So the number of homes for sale has remained very constant all summer. The other thing that's been remaining fairly constant, although overall declining since the beginning of August, is buyer demand. And those are pending sales. And the change in the numbers is not terribly significant, and it has remained relatively constant. But this sort of downward slope, if you want to call it that, is just sort of runs in line with the rate increases that we've seen. There was an uptick in pending sales when we had some good rate news for a couple of weeks, and then rates have been, kind of I don't want to say disintegrating. They've been rising. That's the word I'm looking for. Rates have been rising, and demand has been steady but soft in my view. And then closed sales have been following right along with that. The other thing that's been happening all summer, really since the end of June, is the number of new listings has just continued to go down and down and down. And this is indicative of homeowners saying, you know what, if I don't have to move right now, I'm not going to, because I missed the peak of the market and I'm just going to wait for it to come back. If you don't have to move and you've got a great rate on your loan and you're happy with your payment, then that's the best hedge against inflation that you can possibly have, because you're locked in on a 30-year fixed. We don't have a bunch of homeowners running around like we did in 2006, 7, and 8 with these crazy adjustable mortgages where they're looking over their shoulders and waiting for that thing to blow up in their face. Most people, a vast majority of homeowners, have 30-year fixed mortgages, and they've gotten them in the last several years, so the rate is likely very good and the payment is likely very comfortable for them, or at least not outrageous for them. At the same time, I don't have the number on here, but the foreclosure rate right now in California in general is very low. So we really don't have a distressed property situation that's coming up to bite us right now. What we do have, though, is a situation where interest rates have been on the march, pretty much since the beginning of March. I just said March twice there, didn't I? So we had the first big Fed bump in late May, early June, and rates went up, and then rates went sharply up toward the end of June, and then we had a little bit of relief heading into September, but then really since the beginning of the month, they've been going up and up and up. And now here we sit. The Freddie Mac numbers are telling us that the 30-year fixed average right now is 6.29%. And that is really not great given where demand is. It's certainly not going to help demand. And then, of course, you got your 15-year fixed at 5.44 and your 5/1 ARM at 4.97. And these are the three major products that Freddie Mac is tracking right now. And I will say you should take a look if you're interested in rates. If you're thinking about buying, take a look at the video that I did. I believe it was last week with my lender friend John Fuller. In fact, we've got another video coming out in the next few days where we are talking about ways that you can take a 30-year fixed mortgage and get a credit from the seller, roughly 2 points, call it roughly a 2-point credit, to do what we're calling a 2-1 buy down. If you have a conforming loan, which is going to be under 720-ish, I believe, I think 717, somewhere in there is a conforming loan amount. If your loan is that or less, you can do this 2-1 buy down. You can buy the rate down, or the seller can help you buy the rate down by 2 points in the first year, 1 point in the second year, and then it goes to the note rate, which would be, whatever the 30-year fixed is in the third year. But of course, rates are going to come down once we get inflation under control. Most people don't even keep a 30-year fixed mortgage for, I believe the average is 5 to 7 years. But in any event, this 2-1 buy down can help you as a buyer get a lower payment. And on a $700,000 loan, that's roughly $850,000, $900,000 house, if the math in my head is roughly correct, that's going to save you $800 a month in the first year, about $400 a month in the second year. Then you're going to refinance into a rate that's somewhere in between. But the bottom line is you can save money on the way in, and it will also help the seller, because there are plenty of sellers right now that want to sell, but they don't want to do a massive price reduction. But if they credit you as a buyer $15,000-ish, that's a lot better for them than doing a $30,000 or $40,000 price reduction. And in fact, a $30,000 or $40,000 price reduction isn't going to help you as much as the 2-1 buy down will. So look for that video and ask me if you have more questions about that, because I think in part that is going to be one of the many solutions to our current situation. And then let's go ahead and move on to median price. Now this is a number that it's exactly the same as it was when I talked to you about it last week, because we're just looking at this month to month. But I just wanted to make a couple of points about this. I've been saying that, yes, the median price is higher now than it was in January. However, I think we can safely say now that we are establishing a trend, and the trend is down. So here we are, January of 2020. Is this going to go down further than that? Probably. So those sellers that are saying right now, oh, I'm going to wait until next year, it's going to be better next year, I'm not so sure. I think we have established a pretty sharp downward trend that looks almost as sharp as the upward trend, or even as sharp as the upward trend that we had earlier this year. And once we start in this direction, it's going to keep going. Where does it stop? Nobody knows. I mean, you can see here in 21, it did go down for 1, 2, 3 months in a row, and then it sort of sputtered a bit and came back and then shot back up like a rocket. Is it going to shoot back up like a rocket in 2023? No, not unless rates go back to 2.75, and that's not going to happen for at least another year or so. I think we're probably, a lot of experts are telling me that we're looking at June, July of next year for rates to kind of start coming down again from the mid to high 5s and 6s, what we're seeing now. So anyway, if you've got a home to sell, you really need to pay attention to this, because it's really not getting any better for you. And to pine away for this equity that's here, it wasn't yours because you didn't sell during this hump, this peak. And if you didn't sell during the peak, but you need to sell, or you really want to do something, waiting until next year is not going to help you, because it's going this direction. But the good news is, whatever you're going to buy next is also doing this. So, it all comes out in the wash, as they say. So that's what's happening in San Diego real estate this week. Welcome to autumn 2022. Hopefully after this next hot snap, things will start to cool off a bit and give us some relief from the hot temperatures that we're going to see over the next few days. Anyway, it's not a weather report, it's a real estate report, right? What are you doing, Eric? I don't know. So if you like this content, please like, share, subscribe, tell your friends, send smoke signals, whatever you've got to do to get people to like, share, and subscribe and comment on this content. We will be back next week with some more Neighborhood Watch and again with San Diego Market Watch. So for now, I will say goodbye and we will talk to you later.